So what's your preference, Matthew? I mean, deep undervalued businesses trying to make a return from mean reversion, or growth businesses, looking to hold them for a long time? Because here, among our viewers, we have both types. So which type are you?
That is a great question, Rupam. I think I'm a combination of both, and I'll incorporate each into our portfolio. And in a way, you get diversification simply by having both in a portfolio. Uh, it is it's much more challenging to find them, but when you can find a long-term Fisher type compounder, that is a much that is a greatly preferred strategy. It's better for the long-term IRR, depending on your jurisdiction. It's better from a tax perspective, typically, because in the US, at least, anytime that you switch securities, you have to pay shorter long-term capital gains tax. And so you have to re-catch up to your old high watermark after those taxes are paid. So it's certainly beneficial to find a long-term compounder if you can get something that's in the high teens, 20 or more percent in growth, and just sit and do nothing for many years. That is a wonderful business. It is, there's just not very many of those available. And so a lot of times, if there's something that's completely mispriced and it's not growing quite as well, we will take the same Graham approach. We do very deep value analysis, fundamental analysis. And certainly if something looks like it's has a double or triple over the next 12 to 24 months, it's still very attractive for us. So it's a little bit of a combination. And I think taking kind of looking at things through both lenses is important. So we're often from a Ben Graham perspective doing analysis, and then we're also looking from a Phil Fisher analysis, and we have both.
Does it make sense to differentiate businesses into value and growth when it comes to long-term investing, or the end results are the same if the business are compounding?
That's a great question as well. I think in general, the media and talking heads and a lot of people around the world sort of bucket things into the two systems between value and growth. And I think it actually causes a lot of problems for many value fund managers. So if you were to say, do a screen, and screenings, I'm not really a big advocate of screening, but if you were to do a screen and then just automatically sort of, eliminate any firms that have some high multiple, you're going to miss a lot of the great companies. So, you have to, as Buffett says, you have to look through the windshield, not through the rear view mirror. So if earnings are growing, it just fundamentally changes the intrinsic value of that business.
Exactly.
And so if you really understand, you need to really understand the business. And certainly we've missed a lot of the high flyers of today, from Amazon and the FANGs and things. They always looked quite expensive, but if you really understand those businesses, there's a value aspect to them. And so I think it's fair to say these are priced more like there's growth, and these are maybe priced like there's less growth.
Yeah.
But frankly, I'd rather be in a slightly undervalued situation where it's growing strongly than to just be in sort of a melting ice cube type business that's trading for 50 cents on the dollar. And so, they do tend to get bucketed, but as you'll also hear from Buffett, growth and value are connected at the hip, and growth just changes the fundamental. If earnings are growing and something's trading for a PE of 25, and you expect earnings to be twice as high in 2 years, your forward earnings is now 12 and a half. and so it's just a factor that needs to be incorporated into the analysis.
Great answer.
It's very interesting that you say this, because just I think a couple of weeks back, I'm not sure whether you read the latest memo from Howard Marks. I mean, he exactly talks about this, and someone with his background, it was very interesting to see a 74-year-old. I mean, how intellectually flexible and agile he is, because he actually got influenced by his son. I think his name is Andrew, and and we were just this guy. So during COVID, he got to spend a lot of time with his son, and just imagine the sheer intelligence around the dinner table. And after that, it was a long memo. And I personally think, I have read most of his memos, and I personally think that it was by far the best one. And he exactly brings out, this point. So, and yeah, I think this is also very relevant for this particular group, because, here we keep discussing, high growth business, and sometimes we also wonder that, but they look expensive. So, I mean.
And if you consider the demographic of our group, I mean, we can see from our poll right away that we have mainly intermediate people in this audience, and between 2 to 10 years of investing experience. So it's a very nice mix. And I think these questions do bother this audience, whether what is value, what is growth, etc.
Yeah. Well, I did see that memo, of course, and I am very fond of Howard Marks and his writings and his books, as well as many others. And so I completely agree. And I also think it's very important to keep an open mind. I have friends all over the world that are in the value space, and I do find that, and I'm guilty of this to some capacity as well, but I do find that those that sort of approach new opportunities with a closed mind are missing opportunities. So I don't personally, for example, participate in any of the cryptocurrency, but I'm not really against it. It's just not something that I find value in, and I find other opportunities. And so I have the luxury of being able to skip over certain aspects, but yeah, there's a whole lot of products out there, and if something looks valuable to you, then there might be some value there.
And Matthew, were you always like this, or did your style evolve over the years? I mean, because considering your background, Goldman Sachs, Morgan Stanley's of the world, to what you're doing now, I mean, I guess it has been quite a journey. So how did your style evolve?
Yeah, it has been quite a journey. Well, I can sort of share. So I think every investor's style evolves over their lifetime. And but there are some sort of special, I think, almost hacks that I've identified and figured out that I'm happy to share with this community. But yeah, when, I was always a value-oriented individual. So whatever I was purchasing, I didn't want to overpay. And so, having that sort of innate quality, I think, is very important if you're going into portfolio management and looking for value opportunities. I mean, I think it truly needs to be part of your personality. So no matter where I was, I still had that bent and orientation. But it's a big question. So I can share some early sort of insight that occurred to me back when I was on Wall Street. And I can also sort of share how things have evolved, I think, over the last few years, because I do recognize more over the last few years that basing things on, say, book value is maybe less beneficial in the new economy. So you actually can create cash flows without having a major factory. And that's a big change, in the last sort of decade or so. So I think people do need to sort of adjust their mindset and pivot. But
follow Matthew Peterson at his website and YouTube channel with the links included in the video description below. If you have enjoyed this video, please smash the like button below and subscribe to our YouTube channel. Join our investment forum at Facebook. Link in the description below.